Hello everyone. This video is part 2 of macroeconomy and industry analysis. There's some noise going on beside me. My wife is doing laundry. Unfortunately, I'm down here in the basement at my house, and that is also where our laundry room is. So I apologize for the extra noise there. Hopefully I'll be able to edit some of that out. In this video, we're going to start off in this topic with talking about business cycles, and we're going to finish the remainder of this topic with this video. So just a little discussion what a business cycle is. The business cycle is a recurring pattern of recession and recovery. It's called a business cycle. The transition points across cycles are called peaks and troughs. So a peak is the transition from the end of an expansion to the start of a contraction. So we can see some peaks here. If you're looking at the blue line, so the blue line is real gross domestic product. So inflation, not inflation adjusted, or excuse me, inflation is taken out of it. The unemployment rate is the red line, and the labor force participation rate is the green line. And then you can see down here that the real gross domestic product over on the left-hand side is in billions of chained 2012 dollars, so it's based on 2012 values. The percent unemployment rate and labor force participation rate is on the right hand side, and we'll talk about all of those as we go through this. So a peak is the transition from the end of an expansion to the start of a contraction. So you can see here, right here would be a peak, here would be a peak, right here would be a peak, and so you can see that that contraction occurs during the recessionary periods. The recessionary periods are the shaded periods here, so we had one in the early 1980s and then one a few years later. One in early 1990s, one in early 2000s, and then a big one right here, that was the financial crisis, and I expect we'll soon see one out here on the right hand side for our current situation. Just to talk a little bit about this chart, we can see here that the GDP tends to contract, or at least the growth of the GDP slows. We see in early 1990s, certainly fairly dramatically in the 2008 and 2009, and also here in the early 80s, that we did see contraction in the gross domestic product, meaning that the U.S. economy produced less one year or for at least 2 months than it did in the previous months. What happens to the unemployment rate is that the unemployment rate goes up, and it goes up because, if companies are no longer producing goods, then those people that are used to produce those goods no longer have a job. So that's not surprising. And then we see the unemployment rate really kind of trend downwards to a very low rate of about 3.5% in the recent past few years. What's kind of interesting to me, at least, about this graph is this green line here. You can see that, and looking at the data, which I don't have on here, but looking at the data, the labor participation rate peaked in 1998. So right around here, the labor participation rate peaked, and then it started going down again. And that's because you've got people who decided that they were going to no longer work, no longer be part of the labor force, which we talked about in the last video. We've got the aging of the baby boomers and them leaving the workforce, and they represent a large demographic shift. And so we see the labor force participation rate going down since that time. So companies in cyclical industries or sectors do well when the economy is doing well, and do poorly when the economy does poorly. Companies in defensive industries or sectors aren't very sensitive to the economy. So which companies or which types of firms are more likely to have high betas? Companies in cyclical industries are more likely to have high betas because they move with the economy. Okay. Some examples of cyclical industries would be your luxury goods. Certainly, that's probably the best example of a cyclical industry. In general, at least, higher end hotels, travel, things that people do when they have more money, when the economy is doing well and people have higher incomes and more stable incomes. These are cyclical industries. Defensive industries are another big one up here, and we'll go more into these later on too. Consumer discretionary. Defensive industries, definitely consumer staples. As we're finding out, a big consumer staple is toilet paper. Utilities tend also to be a staple industry, or a defensive industry. We're going to go through more of these later on in these notes. So companies in cyclical industries are more likely to have high betas. They also have higher R-squares from that market model, because the market as a whole explains the variation in their returns better than if they're non-cyclical in a non-cyclical industry. To some extent, the business cycle can be predicted. There are general types of economic indicators. There are leading economic indicators, variables that rise or fall in advance of the economy rising or falling. And then there are coincident or lagging indicators. So coincident indicators rise and fall as the economy is rising and falling. And then lagging indicators kind of confirm what we're seeing in the market. They rise and fall after the economy has done the same. Really a really good source for this information is called the Conference Board Report. And what I put out here online for you is a couple of publications by them. So this is out on D2L. These are the notes that we're going through. These are the cyclical and defensive sector indexes, and we're actually going to talk about those a little bit later. And here are two press releases by the Conference Board. A Conference Board is a not-for-profit organization that consists of a lot of leading executives in businesses and a lot of leading academics, and they put together these economic indicator reports. So there's I've got two publications by them. LEI stands for Leading Economic Indicators. So here is it stands for Leading Economic Index. So they create an index based on leading economic indicators. And this is just the results of this index for them. So the CEI is the coincident economic indicator. The LEI is the leading economic indicator. And you can see here during the recessionary period, that leading economic indicator started going down before the recession began, while the coincident indicator started going down at the same time that the recession began. We also see it back here where it starts going down. The leading indicator started going down, or leading index started going down well before the last recession. And then down below, well, this is the index up here, and this is the percent change in the indexes. And we can also see definitely some strong movement there with the leading indicator. So I'm going to go to the next one, the technical. Oh, sorry. So here are the 10 components of the index. So these would be our leading economic indicators. Average weekly hours of manufacturing. So if those are going down, that tells us that a recession is probably coming. Average weekly initial claim for unemployment insurance. Manufacturers' new orders, consumer goods and materials. ISM index of new orders. Manufacturers' new orders. Non-defense capital goods excluding aircraft orders. Building permits. Stock prices. Leading credit index. Interest rate spread. and the average consumer expectations for business conditions. So you see a lot of here about manufacturing. Oftentimes what happens with the business cycle is that when the economy is doing well and the market is doing well and people are out buying things, manufacturers get excited, businesses get excited, so they start producing more things to make sure that they have sufficient inventory when those consumers show up. So what happens is that for many goods, the producers will over-manufacture, and then suddenly demand drops because the desire for whatever they're selling has been fulfilled. And we certainly saw this with the housing market in 2007 and 2008, where for many years house builders, construction firms were making a lot of money. The value of those houses were going up by a decent amount every year, much more than they should have been. And so they kept building more and more houses, and there was an oversupply in many areas of houses, and there was little or no demand for them. And so that really kind of started pushing down housing prices, because then you have an oversupply of houses relative to the demand, and so prices have to go down in order for those construction companies and those developers to sell those houses. And so they would start losing money. They stopped building more houses because there wasn't a demand for any more. And that kind of pushed us on our way through to that recession, along with some bad credit decisions by banks. So we certainly saw it there, and we see it in the economy overall. And if you might notice that, I'm going to switch back to our notes here for a second. You might notice that business cycles occur fairly consistently. And I'm just looking at a long-term view back to the early 1900s. We usually go through a business cycle every 9 to 11 years. Sometimes it's a little bit shorter. It certainly was here between 2003 and 2008. But then, here we've got about 11-year cycle between the early 90s and early 2000s. Here we had one in 1981, and then it was strange here in 82 and 83, where it wasn't a very significant recession during that point. But, here overall we just had a little bit of a mess. But then we had about 8 years of calm between the two recessions. So business cycles really are a cycle. Overproduction in the expansion times during the cycle, and then contraction during the recession. So my question here was that, according to the Conference Board report, what are 3 examples of leading indicators? So according to the Conference Board report, 3 examples would be average weekly hours of manufacturing, claims for unemployment insurance, and manufacturers' new orders. Just to take a quick peek here, let's go back to D2L, and we'll take a look at the last item that I have out there for you. So these are the technical notes for the leading economic index. Maybe. Could be. Let's try downloading it. Here we go. Here we go. Okay. So this was, again, February 20th, 2020. And it just goes through what was going on with each of the leading, or overall, with the leading indicators and the coincident and the lagging indicators, and where they got some of their information from. This is how they weighted each of the factors. So you can see very high weight on weekly manufacturing hours, fairly high weight on ISM New Orders Index, and then the next is average consumer expectations. So that's kind of just a short overview of macroeconomic indicators. Industrial analysis. We'll talk more about the economy as we go through this. Similar to an ailing macroeconomy, it is unusual for a firm in a troubled industry to perform well. Economic performance can vary widely across industries. As a result, it's important to identify a firm's industry and the characteristics of that industry when examining a firm. One primary way of identifying an industry historically has been to use the SIC, also known as the Standard Industry Code, of a firm to identify the industry that it's in. The NAICS, National American Industry Classification System, was created in 1997, and I put in here when I wrote these that it's slowly supplanting the SIC for industry identification. That's not entirely true. The NAICS, I think, tends to be a little bit more specific than the SIC, but it's not replacing the SIC consistently everywhere. And so as a result, the SIC codes are very frequently used. We see them a lot in research, and when you're doing industry analysis for a firm, those often also come up. We're also going to talk about sectors. I kind of use those terms, sector and industry, interchangeably. There is a difference. Industries are more specific than sectors. There's about 10 different sectors for equities, far more industries than that. Value Line, which is a really great resource that I'm going to introduce to you later on, identifies about 90 different industries in its analysis. There are 3 indicators of an industry sensitivity to the business cycle. The sensitivity of sales, so you would look at the revenues and sales of the firm or the firms in the industry relative to the overall economy. The degree of operating leverage, so DOL, I apologize, I should have that on here. DOL stands for degree of operating leverage. And it's a measure of the proportion of fixed cost to profits for a firm. The greater the level of fixed costs to the profits for the firm, the more operating leverage it has, which means that it's riskier. So if a firm has a lot of fixed cost, or firms within an industry have a lot of fixed cost, variations in sales will have a large effect on the ability of those firms to remain solvent. So, for example, if you think of companies that kind of go out of business a lot and don't do very well in entire industries. So, for example, airline industries are oftentimes hurting. If there's a change in demand, they're usually hurting pretty good. They have a lot of fixed costs. They have to pay for terminal space. They have to pay for their airplanes. They have to, these are all big, generally fixed costs. Okay, so they've got to make a flight from Dallas to New York. It doesn't matter how many people are on that plane. They have to get the plane from Dallas to New York, because then it's going to fill up with people, hopefully, and then go back or go somewhere else. So the planes have to keep moving, and there's a lot of fixed cost involved with that. The same thing happened with steel manufacturers in the U.S. A lot of them went into bankruptcy because they have very high fixed cost, and the demand for their goods might not generate enough revenue to pay for those fixed costs in certain years. One other example of that is farming and agriculture. The United States government has found that it is so important to keep farms in business that they created the Farm Credit Services, and the lending to agriculture and to farms is very different than lending to a normal business, because the people lending to them have to recognize that the business cycle, or the the kind of periodic cycle for a farm is an annual cycle, not a monthly cycle or a quarterly cycle. And so loans are set up based on that, and those farmers are also generally insured through the same system and have business insurance through that system. Financial leverage is the degree to which the firm's capital structure consists of debt. The more debt a firm has relative to its assets in general, the greater the risk of default on debt. And that's because if the firm isn't generating enough income, they've got a lot of debt. It works the same way as that operating leverage. Those debt payments are generally fixed, and as a result, as they take on more debt, they have greater payments to make, and the greater risk that their income isn't going to be sufficient, their cash flows aren't going to be sufficient to make up that income or make up the payments for that debt. And so these are all things that increase sensitivity to the business cycle, the sensitivity overall of sales to the business cycle, the degree of operating leverage within the industry, and the degree of financial leverage within the industry makes industries more or less sensitive to the sensitive to the business cycle. In order to avoid taking on a lot of risk, a lot of institutions and investors engage in what's called sector rotation. The goal of sector rotation is to invest in industries that will perform well in the next anticipated portion of the business cycle. It only works if the investor is better at predicting the business cycle than other investors. So I am recording this on March 18th. In the last week or two, the stock market has not done well. We've had, I think, 3 circuit breakers triggered, and so what's happening there is that when the value of the stock market drops, certain indexes drop enough, then trading is halted for a short period of time in the markets. They just stop trading, and this came about from previous situations where people panicked and there was a deep loss in the stock market, because as people panicked, it triggered more and more sales of stock, and it kept just dropping the stock market lower and lower and lower. So these circuit breakers are put in place to force everyone to take a breath and reassess the situation, and maybe not sell off, and maybe not panic so much, and where the value of the stock market goes well below the value of the companies being traded on the market. So we've had a lot going on there. So sector, if you could have seen that coming, you could have profited from that considerably through things like short sales. However, most people can't do that, otherwise it wouldn't happen. But if you can predict a little bit about the business cycle, then you can put yourself in sectors that will do well in whatever portion of the cycle we're currently in. So according to MSCI, the following sectors are cyclical sectors: consumer discretionary, financials, industrials, information technology, and materials. So these are the ones that are sensitive to the business cycle, as I mentioned above. So consumer discretionary would be your luxury items. Financials would be your banks and other financial institutions. Industrials would be manufacturing generally. In information technology, that's going to be your Facebook, your Google, those kind of companies, Microsoft, and then materials. Again, that's very much manufacturing, creating raw materials for use in manufacturing. The following sectors are non-cyclical sectors, meaning they're not very sensitive. Consumer staples, I mentioned toilet paper. Everyone needs toilet paper. It's not based on the business cycle. Everyone needs utilities. I have down here energy. This is according to MSCI, and that document is also on D2L. Energy, healthcare, people get sick, they need to go to the hospital. Telecommunication services. So this is different than information technology. Right now, those are your cell phone companies. The telecommunication services, also then down here I also have utilities. Your internet provider would certainly fall in there, water utilities, electrical utilities, all things that people need no matter what is going on with the economy. Here I've got a graph of economic activity. So we have the peak, contraction period. So these are going to be our recessionary periods where the economy is contracting. It's actually getting smaller. The trough is the bottom. And then we have an expansion where the economy is booming. It's doing well. We have bull markets usually during these times. Then we get to a peak. So in theory, investment into cyclical firms should take place at which point in the business cycle? So it should really take place around this trough area, because that's where they're going to take off right after that. You don't want to invest in cyclical industries at the peak, because then they're going to drop in value. Their earnings will decrease probably as a result of going through contraction. So cyclical firms should, investors should invest in cyclical firms around the trough. Where should investment into non-cyclical firms take place? That should take place around the peak. What is the driving force behind the business cycle and the timing of investments? This is something I mentioned before. The driving force behind that is really manufacturers and producers chasing after profits and chasing after more sales beyond the point at which the demand for those goods and services have been met. In other words, they're generating excess inventory, okay, and excess capacity. And when I say capacity, what I mean by this is a greater ability to generate goods and services, because in order to increase their capacity, their inventory, and increase their growth in their sales, they have to generate more capacity too, to generate more goods and services. So if you want to put it in a word, what drives the business cycle is greed. People chasing after more and more profits and pushing the amount of goods and services in the economy beyond what the demand for those goods and services are. And then what happens is, when they have a buildup in inventories, they start laying off workers, which leads to lower domestic production, which leads to contraction and a recession. If the market is semi-strong form efficient, can you consistently outperform the market through sector rotation? And the answer would be no, because the leading indicators are publicly available. So a little sidestep here. I talked about using, if you can figure out the future, you know what to invest in. But this is also helpful if you can't determine what the future is. We know that we're going to go through recessionary times. We know we're going to go through expansionary times. And so another approach is just to make sure that you are diversified in the different sectors between being in a cyclical sector and being in a non-cyclical sector. So moving on to industry life cycles. The industry life cycle is typically described in 4 stages. The startup stage, this is characterized by rapid growth and individual firm uncertainty. In this stage, firms generally reinvest all income. So they're not paying out dividends, they're not repurchasing stock, they're using all available funds to grow their capacity of their business. This is a time that is full of uncertainty for the firms because they don't know if the market's going to accept their business and if customers are going to want to engage in business with them. A consolidation stage is characterized by growth faster than the economy but slowed from the startup stage. The surviving firms at this stage face less uncertainty. The maturity stage, the product has achieved its full potential for use by consumers and growth is generally limited to the growth in the economy. So this is where firms become mature. Firms can become cash cows at this stage. So some examples of cash cows would be Apple, Microsoft, maybe Coca-Cola, certainly Altria, they make tobacco products. The remaining firms within an industry oftentimes start to compete more on price at this stage, so they try to become the price leaders because they no longer are they very well differentiated. Apple Computer being an example of that not being entirely true because they are very much differentiated from other similar products. But in general, firms within this maturity stage do start to compete more on price. And then the relative decline stage is characterized by growth at less than the rate of the economy or even shrinkage. Pepsi and Coke actually went through this a few years back where their sales actually started declining. I'm going to talk about that here in a minute, that general idea. This can be triggered by obsolescence or new low-cost competitors. So the things to know about this, one big thing, and this is a fairly recent idea. It's been something I started researching about a year ago. One important thing to note is that firms don't necessarily follow the industry life cycle in order. Right now I'm working on research that further examines this idea, but essentially what happens to firms is that sometimes they go through this. So if you're familiar with Radio Shack, they certainly went through this. They're very popular for a long time, and firms in that industry, your kind of specialty retailer, eventually what happened, they went through relative decline where a lot of people started buying those things online rather than and as a result they weren't generating enough business to keep the brick and mortar stores alive. A lot of retail has gone through this. Think of JCPenney, Macy's, Sears. Those companies have also gone through that industry has also gone through this, where we're certainly in relative decline for that industry right now. But the thing here is that firms don't necessarily follow the industry life cycle in this order. Oftentimes firms within an industry will innovate into new areas, new product and service lines in order to avoid the relative decline stage. And so what they'll do, what firms will do, not industries, but what firms will do is they'll start to diversify away from maybe their core product or service in order to generate more cash flows, and really kind of push themselves from one industry to another. The next thing I'm going to talk about is the BCG matrix. BCG stands for Boston Consulting Group. And the way it ties into industry analysis is that firms within an industry fall in this BCG matrix, in part due to the industry and the industry life cycle influence of that industry. So on the vertical axis over here, the market growth relative to market share. So this is the market growth of the industry. Okay, so is the industry growing? If the industry is growing, if market growth is high for the industry, the firms within that industry will either be question marks or stars. So a question mark is a firm that has low market share within the industry, but there's high market growth of that industry. Stars are firms with high market share and high market growth. For industries that have low market growth, so they're kind of slowing down, they're in those maybe the mature stage of the industry life cycle. The firms within that industry can be dogs, low market share and low market growth. So they're probably going to be going into decline, those firms are. Or they can be cash cows. They can have high market share and low market growth. So these would be firms that are in mature industries but have a lot of, they own a lot of that market. So for example, I mentioned Coca-Cola, McDonald's, maybe Microsoft, maybe even Apple. The growth of that industry is not high right now. So certainly those could all be considered cash flow cows, and what we see is that they generate a ton of cash that's not being reinvested. So industry structure and performance. There's Porter's 5 forces of industry structure. And these are pretty good things to think about when you're thinking about an industry that you feel like you need to invest in, to kind of take this test and go through these and determine if the industry itself is going to be profitable. So what I hope you're getting a picture of is that we're going to drill down. We're going to, as the next several weeks in the class, we're going to be looking at the macroeconomic situation, and it is evolving right now, and that's going to make things more interesting, but a little more difficult too. And then we're going to drill down and find what sectors should we be investing in that we're not. And maybe there's some sectors that we're over-investing in. And within those sectors, what industries are attractive right now? And then we're going to narrow it down to that, and then you're going to pick out some firms that you think might be good additions to the portfolio based on drilling down to that industry level and saying these are industries that we should be more exposed to, and these are industries maybe that we're exposed to now that we should be less exposed to. So the 5 forces of industry structure indicate how profitable an industry will be. Intra-industry rivalry. So if intra-industry rivalry is high, then the industry will generally be less profitable. because the firms within that industry are competing against each other. One way that they can compete is through price. So being your low cost producer and selling at the lowest cost will often generate market share. And that's where those companies want to be. So, but that will also lower profits within that industry as a result. So if you can think about some companies or some industries where there's a lot of intra-industry rivalry, where you've got people competing very heavily against each other. Some examples of this might be, especially back in the late 1980s, we had the Cola Wars. And it's certainly the level of rivalry was much higher back then, but it still exists now, where you've got Coke and Pepsi trying to outdo each other and trying to fight against each other. You've got certain luxury car companies that do this as well, where they try to, be the best, in consumers' minds, be the best car company out there. But if an industry has a high level of rivalry, that's going to push down profits. This one I should change a little bit because the new entrants versus barriers to entry are kind of counter to each other. If there are high barriers to entry within an industry, if there are high barriers to entry, this will lower the number of new entrants. New entrants into an industry lower profits. High barriers to entry increase profits. There's a number of different ways to generate high barriers to entry. There are legal ways to create barriers to entry, such as patents, trademarks, geographic restrictions. So, for example, cable companies. We don't have 10 cable companies, and no place really does in one location, because there is a restriction on the infrastructure. Those companies have to help pay for the infrastructure, getting the cable to people's houses, and so we don't want 10 different companies laying 10 different types of cable all over the city. Usually there's a restriction on that. Investment into capital, production capital. So if it takes a lot of money to pay for the equipment for an industry, then that's going to create a barrier to entry for other people to get in. Investment into trademarks and reputation. This is one of the reasons why Apple has done so well. They've invested a lot in their reputation and just the idea of Apple and their trademarks and making sure that they're well known. Same thing for Coca-Cola. And this kind of restricts, along with those patents, restricts new entrants from coming in and making the industry more profitable. If there are substitutes for the product or services, a lower cost substitute for the products or services being generated by the firms in that industry, that's going to lower profitability. So clothing, for example, is one area where you can, if you're comparing a higher end item, or a high cost item, you can often find lower cost substitutes for that. Supplier power, this is the power that a supplier to a firm has over the firm based on the need for the supplier's materials. A rule of thumb here is that if a supplier provides materials for at least 20% of a firm's sales, then the supplier has power over the firm. So let's say I open a store up, and actually this is a true story. I did start a company up many years ago. We sold medical uniforms or scrubs. It was me and my wife, and we had a franchise agreement with the supplier. So they actually provided about 90% of what we sold. We also did some custom. We had someone sewing custom goods for some of our customers, but they sold about 90. We counted on this supplier for about 90% of our sales. Unfortunately, the supplier was down in Florida. There was a big hurricane. They got flooded out, and they said, you know what, you're a small buyer from us, so we need to take care of our big customers first, and they put us out of business. Don't worry about us. We actually had made all our money back within like 6 months, so we weren't out anything. Both my wife and I had other jobs at the time. It's something we were just trying out. But you shouldn't depend too much on a single supplier or a handful of suppliers. If you do, or firms within an industry do, this is going to reduce the profitability because those suppliers can negotiate better prices for themselves because they have power over you. Buyer power, this is one that there's some confusion about sometimes. So this is the power that a customer has over the firm. Just like supplier power, if a single customer is responsible for at least 20% of a firm's sales, then the customer or the buyer has power over the firm. This was a serious problem for a lot of Walmart suppliers, and probably still is. At one point, Walmart said that they didn't want to be responsible for more than 10% of a company's sales. So, for example, they didn't want to be buying more than 10% of the goods that Johnson & Johnson produced, or more than 10% of the goods that Rubbermaid produced. And they said it was because they didn't want their decision to no longer do business with a company to put that company out of business. The problem came about when Walmart got so big that they sold more than 10% of the goods within an industry that an industry produced. And so they had to kind of abandon that idea. And they have driven some companies out of business. For example, I mentioned Rubbermaid. They drove Rubbermaid out of business because on their shelves, people could go in and choose between Rubbermaid goods. So, think about your kind of big containers, trash cans, or Rubbermaid trash cans and things like that, or Sterilite, and Sterilite makes the same things. Okay? Well, Sterilite was often lower priced than Rubbermaid goods, and so Walmart went to Rubbermaid and said, you've got to lower your prices. We've got some ideas to help you out with that. One of those ideas is that you're going to move production overseas where it's cheaper to produce. And Rubbermaid said, no, we're not going to do that. We believe in being made in America, and we're going to stick with that plan. And so Walmart said, well, then goodbye. You're taking up valuable space in our stores. People aren't buying your goods because they're too high priced compared to the substitutes that we have for sale in our stores. And as a result of that, Rubbermaid went bankrupt. They went out of business, and they got purchased by a company called Newell, Newell, and the company then became Newell Rubbermaid, and subsequently you can buy those products now in Walmart stores. So these are the things that make an industry profitable or not, and things you should evaluate as you look through different industries for investment ideas. This finishes the notes on macroeconomy and industry analysis.